The largest drawdown in the history of the fund today. We just had the largest drawdown on Monday. Well, we broke that record today. We are down 10%. This is the largest drawdown in dollars that the fund ever had. Again, it's partly also a function of the high NAV, but still, I think we need to discuss this. The reason in particular is the bond market jittery, very extreme moves in the bond market, which have created havoc all around the financial markets. This is the Not Even Wrong podcast. It's February 25th, 2021. This is Krim Belko. For the day, the fund is down 10%. The market's down 2.5%. For the year, we are now down 2.4%. The market is up 2%. We're underperforming by 4.4%. This is the first time since this podcast series started last June that we are underperforming the market. It's the first time that we are actually negative for the year. These things are the way they are. The podcast is supposed to give people a sense for what it feels like to run a hedge fund, and nothing better than explain how it feels when you are taking large drawdowns. Our drawdown for this year now is something in the vicinity of 22-23%. So meaning from the peak of the fund, we are down something in the mid to low 20s. And while we had drawdowns like this before, this is not the first time. Again, in dollars, this is the largest that we ever had. The problems are manifold. Let's start with what's going on in the market. So we had a massive sell-off in the treasury market. In fact, the treasuries are the reason for all this turmoil. In my view, this is obviously our opinion, but I think people would agree, because we had this very unprecedented parallel moves of treasuries selling off, the financial market selling off, the stock market selling off, the commodity market selling off, gold selling off, everything selling off. Even the dollar sold off in the beginning. Now it's strengthened a little bit relative to the euro. So there was this massive sell-off of everything. So what does that mean technically in plain mechanical terms? That means everybody's selling every security possible and hoarding cash. Now, if we look back to when that happened last time, which was I think in March or early April, when the COVID crisis started last year, we had a sell-off in the treasury market also, parallel with selling off in all other financial markets. And the same thing happened back then. And the reason for that particular sell-off was that there was just this treasury, let's call it the treasury plumbing. I spoke with Professor Duffy at Stanford about this. So the treasury plumbing just doesn't work. The banks cannot take on as much treasuries anymore. The trading is so vast, and the banks, the primary dealers in the treasury market, just cannot take on more treasuries to trade them, because of their own balance sheet requirements, and that created a lack of demand for treasuries, and then the whole thing started unraveling. Now, as far as I know, today wasn't that bad, but then we also don't know what happened in terms of the Fed stepping in and things like that, because what we could expect is when we have this kind of unraveling, we would typically expect the Federal Reserve to step in and do something about it, and this is probably what happened today. Nevertheless, we had a massive sell-off in the bond market, and let's try to analyze that a little bit. We had this in the morning meeting. You have one thing is to have a sell-off in the bond market. The other thing is to find a reason for why this is happening. I think it's worth thinking about it at least. And what we think is happening is that the bond vigilantes are out, and this is analogy to the early 90s when Bill Clinton was president, or just got elected president, and the Democrats had power in the House, and I believe at least in part of the Congress. So they wanted to start doing some typical Democratic things, which is redistributing wealth and also spending more money and things like that. And the key here is that the bond market said, no, you cannot do that. And we see a parallel today with Treasury Secretary Janet Yellen. Her statements have been very, very disturbing recently. She wants to basically help poor countries. She wants to raise wealth tax in particular. She wants to actually do an unrealized gain tax, or a wealth tax on Americans. These are unprecedented statements, and the bond market is just voting with their feet. Like, we're not gonna give you money at this low rate if you start talking like that. We don't like this kind of language. So we believe that this is definitely partly the bond vigilantes acting out. So the bond market is testing Janet Yellen is testing the cabinet, but also testing the Fed. Now, what's going on here? The Fed, of course, has the mandate to keep financial stability. So what Janet Yellen could just say is point to the Fed and say, hey, guys, stabilize this. And the Fed might say, well, no, we don't want to stabilize this because it's your fault. You can't talk like that. This is dangerous. What you're doing is not good. And therefore, we see a possibility of, let's call it, pretty complicated situation in Washington going forward. And that's not good for the markets, of course. That's not good for stocks. That's not good for our positions. We are down 10% today, 7% Tesla, 3% in the genomics index. Very, very bad day for us. So we're basically down 10% in genomics stocks. Now, that's of course expected when the Nasdaq's down 3.5%, that our stocks will underperform. They have high beta, and we are seeing that right now in high correlation markets like today. So when everything is correlated, our stocks actually do underperform the Nasdaq. This is unfortunate. They are to some extent also overvalued. So there's a correction in those stocks. At this point, we are now down for the year about 2% in the genomics index. In fact, we're flat on Tesla and down 2% in genomics. So our drawdown this year in the market comes purely from our biotech stocks. We've discussed this on Monday. I think the most important thing in situations like this is you have to go back to the basics and understand, why am I holding what my holdings? We've discussed yesterday the ARK Invest effect. So the problem with our holdings is not just the problems could emerge from the companies themselves, but they could also emerge from other investors. And in our case, we believe the companies are fine. They are doing what they've been supposed to be doing, which is change life science and biology and digitize it with synthetic biology, cell therapy, and CRISPR technology. This is what they're doing. We're very happy with that. What we're not happy with is that other investors, in particular company investors like ARK Invest, are over marketing themselves, attracting too much money, and in my view, highly levered and maybe fast money, which drives this volatility. And I think this has happened in the last couple of months. And the result is what we're seeing right now. It's a bear market in particular, our biotech stocks. Now, where this is going from here, I think we need to brace ourselves for more impact. There's no way around it. I had a conversation today with one of our investors. They are scared. They should be scared. It is a scary situation when you have the treasury selling off. That's always kind of, the market of last resort is not supposed to sell off in a crisis. So this is scary. We believe that it's because we have this explanation by Patrick Duffy from Stanford, who analyzed in last year's crisis. We believe that there's probably parallels to that. So having an explanation is a good start. Having an explanation is always good. It doesn't save you from ruin, but at least it helps you get a peace of mind. It helps you understand, okay, where do I stand? What is it that I need to do to prevent this? And of course, understanding, let's say, if there is a plumbing problem in the treasury market and this is causing this route, and maybe if the trigger actually wasn't just the plumbing, but actually the statements that Janet Yellen made. So if this is all true, if this is all actually what is going on, then I think we are in a situation where we need to sit tight. We need to try to not panic, first and foremost, but then also try to understand, where is it that this can go? How far down can it go? I think our downside 50%, like I said, is still in the cards. It's a very scary scenario. I wouldn't want to share this lightly, but it is what it is. It is definitely possible. So we need to brace ourselves for that. If we have a 50% correction, we will have 25% leverage. So we're still out of margin call territory. We might have redemptions from our investors and things like that, but that's life. That's something we can't control. The question is, what can we control? And what we can control, and that's very, very important, is our leverage, and it is also our desire to own more of our shares. We are still incredibly happy to own stocks like Tesla and our biotech stocks. And the question, the end game in our fund is to hold as many stocks as we can under the condition that we need to, of course, cover our cost of living, and also, again, not get called through margin calls. These are the key ingredients of our decision making, and we are at this point fine when it comes to leverage. We are fine when it comes to our cost situation. So we can sustain at least for a while without touching anything in the portfolio, and that's a good thing. Let's say that's a good thing. Our thesis is not changing. There are some reasons why our thesis could be changing. For example, the supply chain with Tesla is under pressure, so maybe Tesla cannot deliver as many cars as we thought. This is one possible risk. We've discussed this also, and we believe that that's okay, that Tesla is the kind of company which will be able to manage through the supply chain issues. The other risk is demand. If we have a rout in the market, we will have less demand. We've seen that last year, that Tesla was fine to keep their demand levers intact. That was also not an issue. So overall, I think we are in a position to sit tight, to monitor the situation as it goes, to hopefully have an understanding of what's going on, because that's important when you want to sit tight. When you want to understand when you understand why there is turmoil in the market, then you can sustain the turmoil. The most scary thing is not to know what's going on. So you're the proverbial stupid guy on the poker table who really doesn't understand what's going on. You don't want to be that guy. You want to understand. We believe that Janet Yellen and generally the cabinet of Biden is, for lack of a better word, pissing off the bond market. The bond market is acting. There is constraint in the banking system, which is driving the sell-off in treasuries, and this is what's going on. This is how we explain the drawdown. We are prepared for further impact. Our long-term goal of 15% unlevered return after commissions is still intact. There is no issues with that. We believe that with our portfolio we can achieve that, hopefully even overachieve that. In the short term we'll have corrections. This is normal in the market. In fact, it's even healthy. We believe that this is actually a healthy, every correction is actually a healthy correction, in the sense that it helps streamline the players, it helps streamline the policymakers, it helps streamline companies, it helps streamline investors, it brings out froth in the market. So these are good things, and we believe that once we're out of this, and once we go into Q2, Q3, Q4, and once hopefully the bond market stabilizes, we will continue to generate returns. Thank you.